Hello and welcome back to the QuantScore Financial Show, brought to you by Math and Maticians, where we use the power of algorithms and quantitative trading to find you the best stocks on Wall Street each week. We're using sophisticated models and key indicators to predict the future movement of stock prices. We're talking about the future of investing, and you're getting a front row seat. But before we dive in, remember, this video is not financial advice. It is strictly for educational purposes and to spread the word on algorithmic prediction models for stocks and quantitative trading. Now let's get started. To begin, we'll be addressing our undervalued stocks of the week. First up on our list, we'll be logging into the world of online brokerage with Futu Holdings, ticker symbol FUTU. This company is revolutionizing the way people trade stocks, making it easier and more accessible for everyone. Now this company is on fire, and our algorithms are screaming buy. Futu is not just another brokerage. It's a tech-driven powerhouse that's changing the game. Here's why we're bullish on Futu. They're a major player in the online brokerage space, especially in China, a market that's exploding with new investors. The Chinese market is ripe with opportunities, and Futu is perfectly positioned to capitalize on this growth with the financials to back it up. Their price-to-earnings ratio is a cool 24.56, and with a forward PE of 11.57, stock is seriously undervalued. This indicates that Futu has significant growth potential in the near future. To add to their positive financials, their quarterly earnings growth is a solid 8%, while their quarterly revenue is up over 21%. Couple all of this with a return on equity of 17%, we feel Futu cannot be stopped. These numbers are a testament to Futu's robust business model and its ability to generate consistent growth. Futu is riding a wave of success, and it's showing no signs of slowing down. Our quant score for Futu is a sky-high 19, which means our algorithms are seeing massive potential for growth. This is a company with a bright future, and I think it's time to jump on board before this rocket takes off. Next up, we're heading over to the tech sector with Baidu, ticker symbol BIDU. This company has been a cornerstone of the Chinese internet landscape for years. Baidu is like a sleeping giant, and it's about to wake up and shake things up. The company has been quietly building its arsenal of technologies. Baidu is constantly hailed as the Google of China, a truly glorified comparison, but they're making major moves in artificial intelligence, cloud computing, and autonomous driving. Their advancements in AI are particularly noteworthy. We're talking about a $33.4 billion company with a PE ratio of only 12.5, which is crazy low for a tech giant like this. This valuation makes it an attractive option for investors. Sure, their quarterly revenue growth might be a bit flat right now, but don't let that fool you. The company is investing heavily in future growth areas. Their earnings are still growing at over 6%, and with a forward PE of 8.98, this stock is ripe for the picking. Analysts are starting to take notice. Our quant score for Baidu is a very respectable 16, indicating strong potential for future growth. This is a company that's been quietly innovating, and I think it's time for investors to take notice. Baidu's strategic moves could make it a major player in the global tech arena. Now, let's talk about a company that's changing the game for millions of people living with diabetes. Dexcom, ticker symbol DXCM. This is a company that's on the cutting edge of medical technology, and their stock is on fire. Dexcom is the leader in continuous glucose monitoring, and their products are in high demand. Dexcom currently has a PE ratio of 53.1, which might seem high, but trust me, this company is worth every penny. Their quarterly earnings growth is an impressive 15.7%, and their revenue is steadily climbing as well. With a return on equity of 32%, this stock is still undervalued, and our quant score of 11 confirms that. This is a company that's making a real difference in people's lives, and that's something I can get behind. If you're looking for a stock with both heart and profit potential, DXCM is the one to watch. Next up, we're heading back to the tech sector with EPAM Systems, ticker symbol EPAM. This is a global software engineering powerhouse that's helping businesses navigate the digital landscape. EPAM provides consulting, design, and software development services to clients across a wide range of industries. We're talking about a $14.22 billion company with a PE ratio of 32.51, which is in line with its peers in the tech sector. Their quarterly earnings growth is a stellar 43.6%, and their revenue is steadily increasing. With a forward PE of 20.96, this stock is still undervalued, and our QuantScore of 11 reflects that. This is a company that's at the forefront of digital transformation, and their expertise is in high demand. If you're looking for a tech stock with strong growth potential, EPAM is definitely worth considering. Alright folks, let's talk about something we can all relate to: fast food. And when it comes to fast food giants, Restaurant Brands International, ticker symbol QSR, is a name you need to know. This company owns some of the biggest names in the business: Burger King, Tim Hortons, and Popeyes. We're talking about a $28.31 billion company with a PE ratio of 15.66, which is very reasonable for a company of this size. Their quarterly revenue growth is a healthy 24.7%, and their earnings are expected to rebound strongly in the coming quarters. With a forward PE of 11.61, this stock is undervalued, and our QuantScore of 8 confirms that. This is a company that knows how to serve up profits, and I think it's time to add some QSR to your portfolio. Now, it's time to talk about a company that's raising some red flags for our algorithms: TPG Inc., ticker symbol TPG. This global asset management firm is showing signs of being overvalued. TPG manages investments across a wide range of asset classes, including private equity, real estate, and credit. While they have a $24.82 billion market cap, their PE ratio of 27.32 is a bit high, especially considering their recent performance. Their quarterly earnings growth is flat, and their revenue is stagnant. While their forward PE is negative, which might seem appealing, it's important to note that this is often a sign of uncertainty in the market. Our QuantScore for TPG is a concerning 43, indicating that our algorithms are seeing significant risks associated with this stock. I would approach this one with caution. Next up, we're taking a look at Robinhood Markets, ticker symbol HOOD. This online brokerage platform took the market by storm during the meme stock frenzy, but our algorithms are now flashing warning signs. Robinhood's platform allows users to trade stocks, options, and cryptocurrencies with zero commission fees. However, their business model has come under scrutiny, and their user growth has slowed significantly. With a $46.85 billion market cap, their PE ratio of 91.38 is sky high, indicating that the stock is significantly overvalued. Their quarterly revenue growth is flat, and their forward PE of 0.0151 is another red flag. Our QuantScore for Robinhood is a worrying 41, suggesting that our algorithms are seeing major risks associated with this stock. I would be very cautious about investing in Robinhood at this time. Now let's talk about a company that's been making headlines since the start of the pandemic: BioNTech, ticker symbol BNTX. This German biotech company partnered with Pfizer to develop one of the first COVID-19 vaccines. BioNTech's mRNA technology has the potential to revolutionize medicine, but their stock price has been volatile to say the least. With a $28.98 billion market cap, their PE ratio is currently negative, which makes it difficult to value using traditional metrics. Their quarterly earnings growth is a strong 22.7%, and their revenue is growing rapidly. However, their forward PE of 7.04 suggests that the market is expecting a slowdown in growth. Our QuantScore for BNTX is a moderate 23, indicating that our algorithms are seeing both potential and risk associated with this stock. This is a high-risk, high-reward play. Next up, we're entering the metaverse with Roblox, ticker symbol RBLX. This online gaming platform allows users to create and play games with friends. However, our algorithms are suggesting that the party might be over for Roblox. Roblox's user growth has slowed, and their revenue growth is decelerating. With a $46.84 billion market cap, their PE ratio is currently negative, making it difficult to value using traditional metrics. Their forward PE of 192.31 is astronomically high, indicating that the market is expecting unrealistic growth in the future. Their quarterly earnings growth is flat, and their return on equity is a dismal negative 7.01. Our QuantScore for RBLX is a concerning 23, suggesting that our algorithms are seeing significant risks associated with this stock. I would be very cautious about investing in Roblox at this time. Finally, let's talk about a company that's been a staple in many investors' portfolios for decades, ATANDT, ticker symbol T. This company has long been considered a reliable investment, especially for those seeking steady income through dividends. This telecommunications giant is known for its juicy dividend, but our algorithms are suggesting that it might be a trap. Despite its reputation, there are underlying issues that investors need to be aware of. ATANDT is facing intense competition in the wireless and broadband markets, and their debt load is substantial. This competition is not just from traditional telecom companies, but also from tech giants entering the space. With a massive $146.92 billion market cap, their PE ratio of 4.674 might seem appealing, but it's important to look beyond the surface. A low PE ratio can sometimes be misleading. Their quarterly earnings growth is flat, and their revenue is stagnant. This lack of growth is a significant concern for long-term investors. Their forward PE is currently negative, which is a major red flag. This indicates that the market has low expectations for the company's future earnings. While their dividend yield is attractive, it's not enough to offset the risks associated with this stock. High dividends can sometimes be a sign of underlying financial stress. Our QuantScore for T is a concerning 8, indicating that our algorithms are seeing significant risks associated with this stock. This score reflects various financial metrics and market conditions. I would be very cautious about investing in ATANDT at this time. It's crucial to consider all these factors before making any investment decisions. And there you have it, investors. Another edition of the QuantScore Financial Show is in the books. We've covered a lot of ground today, from undervalued gems to overvalued traps. Remember, these are just a few examples of how our algorithmic models can help you make more informed investment decisions. Thank you so much for tuning in this week to the QuantScore Financial Show. Remember, this video is for educational purposes only and not financial advice. Don't forget to hit the thumbs up if you enjoyed the video, comment down below if you have anything to add or share. Please subscribe to the channel because it greatly supports the work we do, and hit the bell to stay up to date on all things math and finance. Thanks again, and until next time, stay calculating, my friends.